Refinancing a home can be a wonderful way to improve your financial situation, lower your payments, or receive necessary funds for a large investment. There's a lot more to refinancing a home than simply renewing the loan, cashing out positive equity, or getting better mortgage rates. Keep watching for the primary reasons to refinance. Reduce interest. Assuming you meet the refinance requirements, you may be able to renew your loan with a lower interest rate. This is a great way for homeowners to save a substantial amount of money throughout the length of the loan. For example, a $250,000 home with an interest rate of 4.0 over the course of 30 years will actually cost you $429,673.77. That's roughly $180,000 paid on interest alone, which is roughly the price of a second home. A home at $250,000 at a lower interest rate to 3.25, however, would only cost a total of $391,685.69. That's a savings of nearly $38,000. Reduce monthly payments. One of the best things about refinancing your home is that you can use it to lower your monthly mortgage payments. This is, of course, assuming you don't use the refinance to take out cash against the equity. However, if you refinance the loan based on what you owe and receive a lower interest rate and payment, it could save you hundreds of dollars each month. Reduce loan length. If your financial situation has improved and you can afford higher mortgage payments each month, you could refinance to reduce the length of the loan. Consolidate debt. If you meet the refinance requirements and have a decent amount of equity in your home, refinancing may be a brilliant way to consolidate high-interest debt into your low-interest mortgage. For example, the average American has over $5,000 in credit card debt at a typical interest rate of 19%. Other loans and debts have equally high interest rates. If you could refinance your home and use the positive equity to absorb those debts under a lower interest rate, it could save you thousands of dollars. Additionally, using a refinance to consolidate your other debts will likely lower your total monthly payments. Cash equity. While it's not always recommended, some people refinance their home to take cash equity out of their home's total value. This can be done to make larger investments such as second homes, vehicles, etc. However, you must remember that you're borrowing against your home, which can create larger financial issues in the long run, increase your overall debt, and possibly negatively affect your credit score. Line of credit. Some homeowners refinance their homes to take out a HELOC or home equity line of credit. These are typically used to upgrade or renovate the home in some way. This includes bigger projects such as updating an entire kitchen or bathroom, creating more outdoor living space features, adding rooms onto the house, and more. This can be looked at as a good investment, as these updates and renovations also serve to further increase the value of the home. ARM to FRM. Finally, you can use a refinance to change your adjustable rate mortgage to a fixed rate mortgage. This can be a wise move for homeowners who are planning on staying in the home long term and want to lock in a low interest rate. Choice Home Mortgage exists to help people like you refinance their homes to pull out cash equity, pay off debt, consolidate debt, lower their interest rates, and more. Apply now to see what you qualify for, or call us with any questions or concerns. Thanks for watching, and if you found this video helpful, be sure to like, comment, and subscribe.